It is very hard to give a generic rule about entry points because we have seen that you can enter pretty much anytime you have two conditions. The first one is that the setup of the Ichimoku is in your favor, so you have the two fundamental conditions plus other 10 points from the other conditions. The second one is that you have a good opportunity in terms of risk to reward ratio. Of course, you don't really want to analyze any single candlestick to see if the setup gives you the opportunity to open a trade or not. So I want to distinguish two kinds of entries: entry after a new trend and entry joining an existing trend. A trade on a new trend is an opportunity that you usually have when the price breaks through the Ichimoku cloud. We have already seen some examples in other lectures, but I want to show you other examples here. We have pound US dollar on a daily chart, and here we have a clear breakout of the cloud with the chance to join a new trend. After this candle, we have the price below the cloud and the blue line going down. The price is below the blue line, but the red line is not clearly below it. The color of the cloud 26 candles from here is still green, even if it is about to turn red. The Chico span then is below the price. Not a clear opportunity, maybe we can wait for the next candle and you can see that we have the red line starting to go below the blue line and the color of the cloud turning red 26 candles from here. So we can open a short position after this candlestick. Another example of entry after the breakout is right now on the same currency pair. The breakout here is not clear as the previous one, but analyzing the current candlestick, the price is above the cloud and the blue line is going up. The price is above the blue line, the Chico span above the price, and the color of the cloud is green 26 candles from here. The only condition that we don't have in our favor is the red line that is still below the blue line, but we have enough conditions to consider a long position here on this candle. So we have seen the trading opportunities trying to catch a new trend on the breakout of the cloud. A trade joining the trend is an opportunity that you usually have when you already have a clear trend on the market and the price is retracing on an important level of the Ichimoku. As important levels for this technique, we will consider the blue line and, above all, the first line of the Ichimoku cloud. A very good example of it is the daily chart on Australian dollar US dollar. After breaking through the cloud, the price is rejected many times at any attempt by buyers to push the price higher. Let's count all the rejections. The first one here on the blue line, a second one here on the cloud. We have then a congestion phase with a rejection on the cloud once again. Then another rejection on the blue line here, a fifth rejection on the cloud with this shooting star, and all of these are opportunities to study the action of the market and plan a short position on an existing downtrend. There are some differences between entering the market on the breakout of the cloud and joining an existing trend. I'm going to talk about the main two differences. The first one is that trading a new trend allows you to have a better risk to reward ratio most of times, but you may have a worse win-loss ratio because there is no confirmation of the strength of the new trend. The second difference is that trading an existing trend allows you to have less false signals because the market already confirmed that the trend is strong, but many times you will not have a great risk to reward ratio. This means that your win-loss ratio is usually higher, but your risk to reward ratio is lower. I tell you this if you want to focus on one of the two techniques because you think that it may suit your style better, but I use the Ichimoku to trade the new trends and also existing trends, so you will see me using both methods in the live section.